Good afternoon, everybody. We'll give just a couple more minutes for folks to jump in from the waiting room, and then we'll get started. All right, I think some are still jumping in, but we'll go ahead and kick things off. Good afternoon, everybody. My name is Aaron Mall, Executive Vice President of Business Development here at iTValuations, joined by my colleagues Christopher Parker and Greg Northrup today to discuss the One Big Beautiful Bill and its impact on your business. We're delighted to have you join us today for this conversation. My joke has been on LinkedIn. These might be the only two people I know who've read the bill. So they've got some insight that I think will benefit those of you who are owning businesses, specifically IT businesses. We had quite a few registrations for the webinar, and several names we recognize, several that are new names to us. And so I just want to let you know who we are at iTValuations. We are a business transformation solution enterprise who we happen to do valuations about a couple hundred a year, almost entirely focused on the IT industry, MSPs being the predominant segment of that population. We also represent buyers in buy-side advisory, sellers and sell-side, not usually in the same deal. That's the fastest way to irritate two parties at the same time, so we try not to do that. We also do a couple mergers a year. We have a CPA firm called IT Tax Advisors, which you'll hear from Greg and Christopher today. Then also launching a cohort peer group model here in the fall called Value Creation Academy. If you'd like to get more information about those offerings or just about us in general, you can scan that QR code in the top right, and we'll be sure to follow up. Those of you who have been to webinars, you know what the next slide is. It's our trivia question. Every webinar, we have typically a guest. We ask a trivia question, and the first person to answer that trivia question correctly, which will actually let you know at the end of the webinar, must be present to win, will actually win a $25 Amazon gift card. So the question today centers around Christopher Parker, who is a first-time webinar guest. He's been at ITV for I think over a year, but this is his webinar debut. So Christopher, when you become famous, this is the moment that launched you, more than likely. But the question is for around Christopher. So the question is, what sport did Christopher play in college? This wasn't like intramurals. He was on a legit competitive team. What sport did he play? And the first person to get it correct, we're not going to tell you if you're right till the end, but the first person to get it correct wins that Amazon $25 gift card. So I had him as kind of an equine guy. He's got that build of someone who would be a jockey, but we'll see if I'm right at the end. So again, drop those guesses in the chat. A couple housekeeping items before we jump into the content. A webinar in September, just a couple weeks out, The Business of Running a Business. This will be with Reed Warren, our CEO, and then Larry Cobrin of MSP CFO. So just to kind of think of this as a fireside chat about running a small business on September 4th. You can register for that on our website, itvaluations.com/webinars. We have several more webinars on tap in October. We'll be talking about those here in the next couple of weeks, but we want to let you know we'll be at IT Nation Connect with a big booth, one big beautiful booth in November in Orlando. So if you're going to be there, make sure you stop by and say hello to the team. All right, enough of me. You're not here to listen to me. You're here to hear from the CPAs, Greg and Christopher. Greg, why don't you maybe start with just a brief introduction of yourself, and then Christopher, you can introduce yourself following.
Yeah, thanks so much, Aaron, for putting this together. And yeah, I'm been on a number of these webinars, but if you are new to this webinar series, welcome. My name is Greg Northrup. I've been with ITV for about 2 years now. Before that, spent just under a decade at BDO, working with high net worth individuals, private equity groups, trust estates. And so coming to ITV, really was just going to do valuations and mergers and acquisitions when I first joined. And then about 6 months to a year in, Reed and I looked at each other and were like, hey, let's start a tax firm because there's such a need in the marketplace. And so IT Tax Advisors has now been around for a year, in which I'm the managing partner and oversee all the tax return compliance as well as all the tax consulting advisory services therein. So it is an honor to kind of convey some of the information that came out as part of this one big beautiful bill with you all here today.
Yeah. Thanks, Greg. Christopher, let's hear from you.
Yeah, I'll just second everything that Greg said. As far as my background goes, I worked at BDO with Greg for just under 5 years. I was actually on his team. He and I worked on a lot of the same accounts. And so we both have very similar backgrounds in terms of clients that we've worked with. And just excited to be working with him again. I came over about a year after Greg did. It was the right fit, and it was the right time to make the transition. And joined the team. When I joined, we didn't have IT tax advisors, and then we launched it, and it's been very amazing just to see how quickly it's grown, because I think there is a very real need, and we've hit it on the head. We've had some really great interactions with many of you, and just looking forward to continuing to have more interactions, honestly, especially around One Big Beautiful Bill, because there are some pretty important. I mean, my favorite thing to talk about with it is R&D credits, because that's been my area of expertise with this thing. I know that there's obviously much more in the bill, but that's what I've been spending a lot of my homework and my time on, and I'm very excited to be talking about that with all of you today. So
Absolutely. Absolutely. Christopher, thanks. Greg, again, thanks for the time. There's a lot, like, to Christopher's point, we could take this webinar in a variety of different ways and paths, but we know our clients well. I think one of the things that, when I think about R&D credit specifically, is you can probably go to any number of tax firms or CPA firms and get help with that. But we know the industry, know the space pretty well. And so what we found is we want to focus the webinar on the content, on the information we think you want to hear most about, and we think will be most helpful to you. So these are the 4 categories we're going to talk about specifically today. R&D credit expenditures. We'll probably spend, I would say, of the 4, more time on the first and the fourth, but R&D will be a big piece of that. Also talk about individual tax ramifications, business and other tax ramifications, and then section 1202 QSBS. And so that's going to be the order in which we do things today. So Greg, maybe start us off with this first piece, maybe a little bit of a history. Where did this One Big Beautiful Bill come from, and how has it changed from what we've had up until this point?
Yeah, it's funny how tax law is basically just one beautiful history lesson in and of itself. And so when you want to understand like why current tax law is the way it is, you kind of have to look historical and look at kind of what all transpired to get us to here. And so the most recent tax law, like kind of wide sweeping tax law change, was passed in the Tax Cuts and Jobs Act back in September of 2017. And in that bill, there was one permanent change and a number of other changes that were set to sunset over an 8-year period of time up through 2025, which would have been, the end of this year. The one change that was made permanent in that bill was the corporate tax rate going down to 21%. However, every other change for the most part in that bill was set with a sunsetting period. And so that's where the number one goal and objective of this administration, when the Trump administration took office, was to go back to the bill that they had originally passed and now make it permanent law, so that we didn't go back and retroactively now have to reenact 2016 tax law in tax year 2026. So a lot of what you're going to see in this One Big Beautiful Bill is not wide sweeping changes to the tax code. If anything, the wide sweeping change is that it didn't revert back to 2016 law. We now actually cemented the laws that were in place as of 2017 in the Tax Cuts and Jobs Act as permanent law. Now, there were a few exceptions to that rule. One of them, during the Tax Cuts and Jobs Act, final minutes, final hours, if you will, of trying to get that bill across the finish line, they needed to do some budget reconciliation items, which basically means we have to find additional revenue to offset some of these expenses and deductions we're doing. And one of those big items that was added was the R&D tax credit change, which forced companies that were taking the R&D tax credit or had R&D expenditures in their business to amortize those expenditures. So if they were domestic, it was amortized over 5 years. If they were international, they had to be amortized over 15 years. The administration didn't like that change being added. So they're like, let's punt it 5 years into the future, give us plenty of time that when we take office again for a second term, we'll have time to come in and, knock that thing out before it ever actually takes root in the economy. History, as we know, that didn't happen. And so now all of a sudden, since that enactment on January 1st, 2022, companies that had been previously taking the R&D credit or had R&D expenditures in their business were now required to amortize those expenses rather than being able to fully deduct them and get a credit on top of them. So what did this mean? Hypothetically, if you had $1 million of qualified R&D expenses, you would add back $800,000 of those expenses in that year, and you'd have to pay tax on that 800 grand. In addition, your tax credit was only the 6% of that $1 million at best. So you might get a $60,000 tax credit with a $300,000 tax bill. That created this completely inverse relationship in what the intended benefit of this credit was supposed to be. So this bill really changed the narrative of that retroactively. I'll turn it over to Chris, who knows all about this and has been studying up on our team, and is really the reason why we're now able to do R&D tax credit studies as a team at IT Tax Advisor. So go ahead, Chris.
Yeah, thanks, Greg. Yeah, I think Greg really hit the history lesson on the head there. The intention was always there, like he said, to go back and repeal it and make it so that you could still maintain that immediate expensing of the Section 174 costs. But with that not happening, I mean, a lot of MSPs that we work with that are in the market ended up never even really engaging with the R&D credit. And so for a lot of you, this is an opportunity for tax savings that, while there might have been a period of time where it was I don't know if it's really worth it. It's one of those things where now, if you're not doing it, the question is why. What are you thinking? Because whenever we're dealing with an MSP company, what we're seeing in the market is generally conservative estimates of a qualifying research expenditures for R&D is 10% of whatever your total spend is. So I've had some conversations with some MSP companies where they're 800 million gross, or not 8 million gross, and then they're bringing home 10% EBITDA, so they've got essentially 7.2 million in expenditures, and of that, you're looking at 10% of that conservatively is probably R&D spend. And the reason why I say that is because the IT marketplace is very unique and that you are so causally linked with innovation. You are constantly looking at ways in which you can improve, and you can improve processes, algorithms. You're doing custom integrations for your clients. You're looking at how you can integrate AI, Power BI, these other things into already existing softwares that you have. These are all things that are common qualifying R&D activities. And so realistically, and this is an example that I like to say, in that $7.2 million expense scenario, what we're looking at is that's $720,000 of qualifying research expenditures conservatively. At the federal level, if it's your first year, that's a 6% credit on that 720. That's $43,000 credit at the federal level. If you are in Minnesota, which is very generous with its R&D credit, it's 10% of whatever qualifying research expenditure. So all in, if you're 100% Minnesota, all your R&D is in Minnesota, and you're at the Fed level, you're looking at $115,000 R&D credit. And that's a dollar for dollar reduction on whatever your tax liability is. And so you can see how that adds up. And on top of that, this is a business expense whenever you're doing these R&D studies. So it's deductible at the business level. And whatever you end up paying out is essentially, not only are you now getting this credit, in the future year, you're reducing your income by that fee, which then means you're also saving taxes on future tax years because of the fact that you're reducing your income. Mm-hmm. And with that, the other spiel that I'll kind of give here, because I know we've got limited time, is just what I've been telling people as a general way of kind of looking at R&D studies. Whenever you're dealing with R&D, the R&D credit, there's really three things that you need to support it. You need your business records, you need your financial records, and you need a breakout of the qualifying versus non-qualifying expenditures. Here's what an R&D study does. The R&D study makes sure that you have the first two, because you should already have the business and the financial records. It makes sure that you have those two, and then on top of that, it's the vehicle by which you actually determine what your qualifying research expenditures are. And often, if it's your first year, you don't really have that stuff in place for tracking that. But that's another great thing about the R&D study is, at least for us, what we do is we give you ideas and recommendations as to how you can make tracking this a part of your everyday activities, so that in the event of ever needing to either go through an IRS audit in the event that you have the credit, or just from a standpoint of efficiency, you are able to continue to improve year over year, and you have what is essentially a silver bullet in the event of an IRS audit, where you're able to answer any of their questions. You're able to give them the documentation that they need and really solidify that you do qualify for this credit and that credit is the right amount.
Let me ask this question. So, Christopher, under your situation, hypothetical situation.
Mm-hmm.
Let's say that was the 2022 reality, and then that was something similar in 2023 and 2024. How are those credits applied over 3 separate years? Walk me through that, what a business owner might expect if they qualify for those credits for 3 straight years.
Yeah, so if they qualify for those credit for 3 straight years, then we're getting into, you can kind of see on here, we've got the 14% of the difference between the current year expenses and your 3-year average. So in this situation, what we're looking at after the 3 years is over and above that average, whatever those expenses are, you're getting 14% of that as a credit. And as you're growing as a business, your expenses they're just going to grow because you're trying to add more top line. You need to add more personnel. You need to do more research because you're trying to expand your offerings, right? And so where you really get to is these averages are your baseline, and then say you're at 3 million top line right now, and in the 4th year you're at 12 million, you're looking at potentially 1.2 million over that, so 14% of 900,000, which is a much larger credit than the 6% of the 720,000.
Yeah.
And so it just continues to build on itself.
Yeah. Great. We'll circle back to R&D things at the end. I want to keep us moving onto the individual taxes. Greg, take it away on individual taxes.
Yeah, like I mentioned in the little history lesson, really the big news here is that you don't have a massive change to the tax code on the individual tax side of things. For the most part, everything's the same. Tax brackets, tax rates, personal exemptions, the lack thereof rather, standard deductions, those are all the same. A couple of minor changes though on the itemized deduction front is the state and local tax deduction, the SALT deduction, if maybe you've been reading about it in the news. This was a heavily debated topic as part of both the House and the Senate versions of the bill, with high income tax states wanting this cap to be either eliminated or raised super high. No, low income tax states could care less. And so what they landed on is a $40,000 cap instead of the traditional $10,000. That's $40,000 for both single or married filing joint. Notice that phase out though, if you have income between $500,000 and $600,000 of AGI, once you hit $600,000 of AGI, your deduction goes all the way down to 10 grand. So it starts phasing out over that gap. So if you're someone that's maximizing your SALT deduction and you have income that lands in that 500 to 600 range, you're technically paying a 45% effective tax rate on every dollar over $500,000 of income, because you're losing the deduction and paying the 35% bracket at the same time, and that's compounding to a 45% effective rate. So definitely a planning opportunity to keep you under that threshold. The other component they did is they permanently enacted the pass-through entity tax. So for those of you that are paying pass-through entity tax in your business and paying that as your avenue for paying state tax versus paying them like separately as an individual, that was permanently passed, so you can continue doing that. However, it might be worth a conversation with your CPA to figure out, does it make sense for us to continue doing that as our PTE tax versus deducting under the $40,000 rule here? Because if I'm already itemizing at the individual level, I might get more of a tax benefit paying those taxes individually via non-resident withholding, and then allowing my business to take a greater QBI deduction. Because if I show more business income, I'm only paying 80 cents on the dollar tax there versus getting that dollar for dollar reduction like I would be if I deducted as state income tax. So that's one planning item there. The next item there, very quickly, itemized deduction phase out. Effectively, if you're in the highest tax bracket, your itemized deductions are doing less for you. Your itemized deductions only give you about a 35% tax bracket deduction versus the full 37% tax bracket deduction when you're in that highest tax bracket. So that's the real change there. But again, you have a high standard deduction, so worst case scenario, you just butt up against that and end up taking the standard deduction. One more slide on individual tax law changes here. The charitable contributions, first time in the history of the code that there is now a floor for individual charitable contributions. And what the floor is think about it similar to like medical expenses, where there's a 7.5% of AGI kind of threshold you have to hit before you can deduct those medical expenses on Schedule A. There's now going to be a 0.5% of AGI threshold that you have to eclipse before you can deduct your charitable contributions on Schedule A. And that's for both non-cash and cash contributions. So, but that doesn't take effect until 2026. So one planning opportunity would be to make some large lump sum gifts here by the end of 2025. If you're someone that gives a pretty substantial amount year in and year out, it might make sense to do maybe bunch giving where you give 3 to 5 years worth of gifts in 1 year and maximize your deduction in 25 versus having it chipped away with both a higher standard deduction and this 0.5% AGI over the next 5 years. For those of you that are taking the standard deduction, you can still get an above the line deduction for charitable deductions. That has to be cash charitable contributions up to $1,000 single or $2,000 married filing joint. So that's similar to the CARES Act 300 and 600 deductions that were available about 4 or 5 years ago. And then lastly, if you're under those phase out thresholds of $100,000 single, $200,000 married filing joint, that might not be a lot of the people on this call because you have very great businesses that are humming with high levels of EBITDA and taxable income. But to the extent if you are under that, you would be able to deduct up to $10,000 of interest on your car loan, which is, again, also a new thing for a personal auto deduction. A couple of things with that: has to be a new vehicle, so you have to be the first owner of it. It has to be under 14,000 pounds, has to be final assembled here in the US. So it can be a foreign manufacturer like a Hyundai or Toyota or whatever, but the final assembly of the vehicle has to be here in the States. And you'll notice as even car dealerships have started to change their language in their car commercials and whatnot, they'll make sure to let you know, hey, this qualifies for that, and then you can deduct that interest. It is an above the line deduction, so it reduces your AGI for some of those other AGI limitations we mentioned up above. So, but I'll
Greg,
turn
quick
over to Chris
question.
on some of the business ones.
Yeah, just real quick, a question from the chat. Does the floor affect non-itemized charitable contributions as well?
No, nope, just the itemized.
Got it. Let's jump to the business taxes. Chris, what are the big changes?
Yeah, so it's more so, I think, about, like Greg mentioned at the beginning, really solidifying those changes that already were rather than reverting. So a really big one here, QBI deduction, 20%. It's made permanent. And then on top of that, one thing that had been starting to phase out was bonus depreciation. And this is going to be a really big one for a lot of companies where you can take the 100% bonus depreciation in the year of purchase. That for a lot of companies, that was a really big tax planning opportunity. And then with it phasing out, it created some issues with with some companies of tax savings, but now it's back. And so it's one thing to consider. And with that, there's also this concept of de minimis that's not really well known still, which is surprising. Greg and I were actually talking about this earlier because we still run across this, where you can immediately expense assets that are less than $2,500. And so what we see is a lot of people still not taking advantage of that. And if you're not taking advantage of that, that's something that you should start taking advantage of.
Mm-hmm.
Fantastic.
Yep. And then those final two items there, estate and gift lifetime exemption went up to 15 million. Again, the story there is it didn't drop down to the 5 million. Subject to inflation, it would have landed somewhere around 7.5, 8 million. So that's $15 million per person in kind of death tax or transfer tax that you get to pass on to your heirs, estate tax free. So that ends up adding up to 30 million for those married filing joint couples. And then for the Trump accounts, this is more of an inform for the future. You can't actually open a Trump account until the 4th of July of 2026. And there's a lot of additional advice and advisory and guidance we need from the IRS around deductibility of some of these contributions and how they're going to be handled. But effectively, thing about this is the big question that a lot of people have asked of, like, I want to give, put money in an IRA for my kid. How do I do it? And the common answer was you can't because your kid doesn't have earned income, right? If I wanted to put money in an account for my 3-year-old, there's no way he was getting earned income, right? And so now this is essentially an IRA for a minor child under the age of 18 without that earned income requirement. So now you can contribute up to $5,000 into that account every year until they turn 18. And then your employer can also contribute $2,500 to that minor child's account, adding up to a total $7,500 contribution, which is effectively the IRA contribution limit. And that's how they're getting to that number. If you also have a brand new child, brand spanking new, they're born between the 4th of July of this year and December 31st of 2028, then the federal government will give a $1,000 stipend into the account when you set it up. So effectively, you'd get $8,500 as that maximum contribution that first year, $7,500 thereafter. It's fully taxable like a normal IRA, upon taking those distributions later in life at retirement age, after age 59 and a half. But one of a couple of things that need to be figured out by the Treasury is the deductibility of that $5,000 contribution, because right now, as the law is written, it makes it sound like it's a non-deductible contribution, which conflicts with the fact they're saying it's fully taxable when it comes out. That would be double taxation if I'm not getting a benefit to put it in, and it's fully taxable when it comes out. So that's one thing that needs to get cleared up. The second thing is the $2,500 from an employer needs to get cleared up, because technically, if I'm a business owner of IT tax advisors, which I am, if I wanted to give that $2,500 to my son, but I didn't give it to Christopher's two kids, that would be a de minimis fringe benefit issue, where all of a sudden now those contributions to my son's account are non-deductible. Well, how do we solve that? If all of a sudden I make it a fringe benefit for everyone, Chris would get more because he has two kids compared to my one. And how do we settle that and make that a fair benefit for all employees, especially if you have employees that don't have minor kids? So more guidance is needed to understand the deductibility and the impact of those two things. I did see a question on grandkids. This does apply to grandkids, kids, nieces, nephews, your favorite kid next door, anyone. You can essentially open up those accounts for them under the age of 18 and make those contributions to them.
This is a great time to announce our July 2026 webinar called the Trump accounts and its impact on your business. I think we'll probably just schedule that now for July 2026. So good information. Last but not least, Section 1202 qualified small business stock gain exemption. Let's just call it QSBS for the rest of the webinar to save some time. Greg, take it away.
Yeah, this one, if you're not familiar, this is really a C Corp tax advantage, and it's probably one of the only areas of the tax code where you can actually exempt yourself from capital gains, with the exception of maybe deferring capital gains via an exchange of some sort with rollover equity or whatnot. This is the only place where you can truly exempt capital gains. In order to qualify, how the old rule was written is you had to have a brand new C corporation and get original issuance shares from that C corp, and then hold those C corp shares for at least 5 years. And then upon selling those C corp shares in a stock sale, you could qualify for up to $10 million or 10x your adjusted basis in capital gain exemption. So you wouldn't pay that 20% capital gains tax at the federal level when you sold. Most states don't conform to QSBS, so you still might owe state tax if you live in a state with state income tax, but at least you would be saving the 20% federal capital gains tax. Now, what changed in the One Big Beautiful Bill was they increased the limit from 10 million to 15 million. So now it's a maximum gain exemption of 15 million or 10x your adjusted basis, whichever is greater, by the way. And I'll touch on that in here in a moment. A couple other things that changed as well is now you don't have to wait the 5 years to get any gain exemption. You can now get 50% gain exemption after 3 years, 75% gain exemption after 4 years. And they even expanded the definition of a qualifying small business to basically be up to $75 million of assets at the time of stock issuance versus just the 50 million, which is what it was before. And that 75 million is set for an inflationary index adjustment every year from this point on. So definitely keep an eye out for that as you're setting up a brand new QSBS eligible or corporation in the future. On the adjusted basis front, if you're someone who's not a C Corp today, and you're like, maybe I kind of want to take advantage of this C Corp opportunity for my company in the future, you can convert your business into a C corporation to take advantage of 1202. You would start your 5-year clock upon doing that, and your adjusted basis would be your fair market value at the time of conversion. So if you have a $5 million MSP today, you could do the conversion, and then $5 million is your adjusted basis, which would make your gain exemption be up to $50 million. Now, if for that conversion, make sure to work with someone who understands Section 1202, both a CPA and an attorney, because there's a specific way you have to do that conversion. You can't just uncheck the box from an S Corp to a C Corp. You have to go through the proper steps in order to qualify. So that's my biggest red flag I want to highlight with this. The second thing I want to highlight is just because there's tax savings here doesn't mean this is the one-size-fits-all philosophy for every business owner. Really, where I see this being the most advantageous for business owners, if A, you say you can live off just your W-2 wage without any distributions, and you're willing to not change your W-2 wage even upon the conversion. So if I'm taking a $150,000 salary right now, I can live off of just that $150,000 salary. Step two, I have hyper growth expectations. So you're not just growing from a $5 million company to an $8 million company over the next 5 years. You're going from 5 million to 30 million. You're going to grow acquisitively. You're going to grow at a 40 to 50% growth rate year over year. And then step three, you have to have very firm parameters around your business on what's business, what's personal. What we have to have a board of directors. You have to really operate like a separate legal entity, even more so than maybe how you've separately operated your partnership or your S corporation prior to the conversion to a C corp. And so if you check those boxes, then this might be a good opportunity for you. The fourth box I'll mention is also timeline, because some people tell me, Greg, I have about 3 to 5 years before I'm going to be willing to sell. Should I do this? And it's like, usually when you tell me a timeline, subtract 2 years, and that's when you're actually ready to sell. So tell me you're ready to sell maybe 7 to 10 years out, and then that maybe will mean that you're going to make it the full 5 to get that 100% benefit, because that's really where you maximize the opportunity that's available here.
Good information, Greg. There's so much more too we could dive into, and so this is a great chance for you to potentially reach out to us, and if we can help you. There's the R&D credit study, which we've just launched. It's a chance to recapture some of those taxes and the investments you've done in R&D. So Greg, talk through the deliverable and how we work with companies to help them maximize their credits.
Yeah, so one thing we briefly touched on and just want to help clarify, if you are under $30 million of gross receipts and you did not take the R&D credit in tax years 22, 23, and 24, you have the ability to go back and amend and take the tax credit in each of those 3 years, to the extent that you had qualifying research expenditures that you can help, back up and solidify, with documentation. You can then take the credit for those years and get a refund on each of those tax years or tax returns. You only have until the 4th of July of next year to take advantage of that. It's the only time that the R&D credit has been made a retroactive amended return election. You only can typically amend the R&D credit if you took the R&D credit on your originally filed return. So this is the only time it's available to you to do that, and you only have a year, and we were already a month and a half into that year time clock. So with 10 and a half months left, it is imperative, if this is someone where, if you're like listening to some of the things Chris rattled off, and you're like, man, I did that. I installed Roost. I did an AI chatbot. I did all these different things in my business. Schedule a call, look at the different R&D expenditures for those years, and let's see if there's an opportunity to amend those returns and get that benefit. If you're someone sitting on the call and you're like, man, I've been taking the R&D credit and I felt the pain of that amortization during the last 3 years. There's a couple more options available to you in terms of, you can either go back and amend, or you can actually take a full deduction of those expenses in 2025, or spread it out pro-ratably 50-50 in tax years 25 and 26. So we would love to sit down with you as well and figure out what would be the most advantageous strategy for you to take advantage of, so that you maximize your refund that you're going to get back from whether you go back and amend versus taking it pro-ratably or all in 2025. So go ahead and scan that QR code if you would like to have a conversation with us to see what that benefit could be for you and your company.
And just to be transparent too, it's $2,500 to get started. But then, Greg, what if you uncover $100,000 worth of credits? What's the fee then at that point?
Yeah, so how we do it, and this is pretty standard in the industry with R&D tax credits, we do a percentage of the credit we help find for you. So it's a 15% of the total R&D credit we find for both federal and for whatever state jurisdictions you're in. And then that essentially that $2,500 up front gets kind of credited against that 15% number on the back end. So it's just $2,500 to get started to kind of find that, and then the 15% on the back end.
And we probably will know even before beginning an engagement if there's R&D credit. So I think if you're worried, well, if I spend the $2,500, I don't really get much back. I think we're probably able to qualify the opportunity well in advance of you making that decision. So yeah, scan the QR code. It leads to a form. You can check mark that you want to talk through the R&D credit, and Christopher and Greg will be happy to connect with you. All right, trivia answer. I think someone must have known right away, because the first guess was the correct guess. Football, or I guess as they call it in the States, soccer. If you're curious what Christopher looked like circa 2015, I did a little search and dropped it in the chat. I'm going to call him Christopher Clean Sheet Parker. He was a goalie, or goalkeeper, I should say. Christopher, were you starting goalkeeper, or were you kind of just warming the bench for the real good goalkeeper? Which one was it?
Well, I was significantly shorter than the other goalkeepers. They were both 6'5", 6'6". So I only played keeper in a couple of games. Where I actually saw most of my playing time was actually on the field, specifically left wing and
Okay.
left midfielder. So because I'm
All right.
ambidextrous, so I was one of those weirdos who could play on the left side of the field and beat people on the left side of the field, which didn't usually happen.
Yeah, man, I thought we were
Awesome.
talking college sports. This looks like a high school photo.
Yeah, I'm a lot
Well, it is
smaller
this.
in that one.
Yeah, it is this. This was before Christopher discovered the weight room, which I think
Yeah,
happened in college and post college. So,
true.
Greg, Christopher, thanks so much for the time today. Really appreciate the insights, and thanks to all of you for joining us. Join us in just a couple weeks to talk with Reed Warren and Larry Coburn from MSP CFO about the business of running a business. Until then, we'll see you. Take care.